Moon Platoon, Meatball is so happy right now because it is our 1-year anniversary. That's right, this channel has been reporting about personal finance, financial freedom, and for you guys for a whole year. So that's why I want to talk to you guys about whether or not Fed Chair Powell has blundered not only inflation, rate hikes, but also the squeeze itself, or whether or not he triggered this squeeze. Let's take a look at this Bloomberg article. Make sure that you guys have already taken a look at that yawning meatball. Every time he yawns, hit that like button and comment out which like you guys are as you guys go to the end of this video, because I'm giving away stuff. It is a 1-year anniversary for not only me, but for you guys. So make sure that you guys watch until the end to understand how and what I'm giving away. Niall Ferguson says Fed's Powell is blundering on inflation rate hikes. And also by the end of this video, I will be showing off some of the buy signals, especially on AMC, that you guys should be looking out for Monday. Okay, first thing. They probably didn't know Big Paul as well as Lloyd Benson knew John F. Kennedy, but they knew him well enough to talk trout fishing in the cloud of a cigar smoke, getting a crick in his neck as well as smoke in his eyes because he was so darn tall. He never met Arthur Burns, Volcker's predecessor, but won as Federal Reserve Chairman who preferred puffing on pipe to cigars, but I think I've read enough about Burns to suggest plausibly that the current Fed Chair Jay Powell has more in common with him than with Volcker. This is unfortunate and potentially disastrous for the US economy. On Wednesday, Powell sought to reestablish him and the Federal Reserve's credibility with an increase of 75 basis points in the federal funds rate. We covered this in the last few videos, the biggest rate hike since 1994. The initial media and market reactions were quite positive. I was and am not convinced. It's not just the Powell Fed has track record for blinking under political pressure. He already had that in common with Burns long before anyone had heard the word COVID. Think back 4 years ago to 2018, the year of Powell's appointment by President Donald Trump. The Fed has embarked on a path of monetary policy normalization after the protracted period of stagnation that followed the global financial crisis of 2008-2009. Basically, we're regressing to the mean after 2008 was a disaster. But Fed funds target rate, having been stuck between 0 and 0.25%, was first raised by a quarter point, 25 bips, in December 2015. Beginning a year later, immediately after Trump's election, then Fed Chair Janet Yellen began climbing a stairway to monetary normality, raising the target rate in 2.25% steps at roughly regular intervals. By the end of 2017, the upper end was a target 1.5%. Powell, who had become chairman in February 2018, kept on climbing, reaching 2.5% just before Christmas of that year. At the same time, the Fed's balance sheet began shrinking. In February 2019, it fell below $4 trillion for the first time since December 2013. Trump repeatedly attacked Powell for his monetary tightening, comparing him to President Xi Jinping of China. We have a very strong dollar and a very weak Fed, he tweeted on August 23rd. My only question is, who is our bigger enemy, Jay Powell or Chairman Xi? There was more and much more. In the space of less than 2 years after he appointed Powell, Trump tweeted about the Fed 100 times. The climax came December 24th, 2018, after a 3-month stock market sell-off. The only problem our economy has is the Fed, tweeted Trump. They don't have a feel for the market. They don't understand necessary trade wars or strong dollars or even Democrat shutdowns over borders. The Fed is like a powerful golfer who can't score because he has no touch. He can't putt. It worked. The Fed blinked. The rate hike stopped. On August 1st, 2019, the Fed cut by 25 bips, the first of 3 cuts before the pandemic stuck. That fall, the balance sheet contraction ended with new Fed purchases of short-term bonds that Powell insisted was not QE, or quantitative easing. 5 decades earlier, President Richard Nixon did not have Twitter at all to his disposal, but his view of Fed independence was not dissimilar to Trump's, as Burton Abrams has shown. No sooner had Burns' Fed nomination been announced in October 1969 than Nixon made clear just what he thought of the myth of the autonomous Fed. On October 10th, 1971, Nixon told Burns that any worries about the liquidity problem were just BS. In the president's own words, "I don't want to go out of town fast," an allusion to his prospects for re-election in 1972. The last thing he wanted was a recession next year. A month later, the two men spoke on the phone. "Look, I want you to know that we are reducing the discount rate today," Burns told Nixon, relaying the news that the Fed had reduced the discount rate, then the main policy rate, by 25 bips to 4.75%. A month later, Burns reported another cut to 4.5%. Good, replied Nixon. Great, you can lead them. Meaning the Federal Open Markets Committee. You always have now. Just kick them in the rump a little. but Nixon was rarely satisfied for long. On Valentine's Day 1972, he complained to George Shultz, who was then the director of the Office of Management and Budget, that Burns was seeking justifications for not raising the money supply. And he added, war is going to be declared on the Fed if he doesn't come around some. As in 2018, with much better political timing, leaning on the Fed worked. Nixon swept to re-election on a booming economy. The price Americans paid came later in the surge of inflation. Oh, it sounds like what's happening right now, which the 90-day price and wage controls imposed in August 1971 and the subsequent price commission and price freeze of June 1973 could only partly suppress. The money supply, M2, grew at double-digit rates in the election year. Velocity, often overlooked, went up in 1973. Inflation peaked at 12% in the last quarter of 1974, by which time, of course, Watergate had definitely swept Nixon out of town. Back in early March last year, along with just a handful of economists, notably former Treasury Secretary Larry Summers and former International Monetary Fund chief economist Olivier Blanchard, I warned of the risk that the U.S. inflation would overshoot as a consequence of fiscal overkill, the $1.9 trillion American Rescue Plan of March 2021, ongoing supply disruptions due to the COVID-19 pandemic, and the disastrously slow monetary policy response by Powell and his colleagues. Their mistake was to think that they could run the US economy hot and explicitly switch to an average inflation target without letting slip the anchor that had held down inflation expectations for 2 decades. Essentially, put your finger all the way down on the button, and then when you let up, hopefully it doesn't spring back and hit you right in the face. Even now, with inflation above 8% and the Fed scrambling to catch up with expectations, they still hear complacent arguments about the transitory nature of the problem, despite the evidence that the monetary policy mistake of early 2021 was even bigger than those of the 1960s and 1970s. The argument is that pretty much every component of inflation except energy is now heading downward, with warehouses, while warehouses are overflowing with inventories. Sure, we can reasonably expect inflation to reach a peak at some point this year, but the lesson of history is that it's unlikely to come all the way back down to below 3% next year, below 2.5% in 2024, and then 2% thereafter. Yet that's exactly the Fed's projections and anticipate, as do those of the Congressional Budget Office and the International Monetary Fund. So it seems like history is directly at odds and with what the people in charge of money are predicting and expecting. That doesn't sound good. But what does sound good is I want to wish you guys a very happy day for the buy signal on AMC. That's from Lux Algorithm. It gives you buy signals like this one that I caught at $11.47. That brought us all the way up to $13 before that strong sell signal. So if you guys want 20% off, it is a very cool tool. But if you guys came to this part of the video wondering what I'm going to give away, I am giving away one-on-one consultations with you guys. So if you guys want to be eligible, the only way is to be subscribed, hitting that bell button on this channel, going to the second channel, hitting that subscribe and bell button, following on Instagram and Twitter. I'm Andrew Mo Money on every single outlet on the social medias, and I want to say thank you guys. Thank you guys for leaving a comment in this video. Thank you guys for being with us for a whole year, and I can't wait for another year and then some. For now, but not for forever. Happy Juneteenth, happy Father's Day, and we'll see you in the money. Peace.